So the election is officially behind us, and not only did we get a Trump win, but we got a complete Republican sweep of the House and Senate. So what does that all mean for taxes? Today we're going to break down everything that you need to know about the changes that are very likely on the way. I promise you don't want to miss today's episode. Welcome back, guys. Be sure to hit that like and subscribe button if you like today's content. And of course, if you need help with your own financial plan, reach out to us at modernwealth.com. That's modern spelled with no vowels, wealth.com. So in order to understand what is potentially on the horizon with taxes, you need to understand how the current tax system is set up. And that is due to the passage of the Tax Cut and Jobs Act. Back in 2016, the political climate was very similar to what we have right now. We had a Trump win and a Republican sweep of the House and Senate. Now, with this GOP trifecta, Republicans made tax reform a massive priority. And so in 2017, the Tax Cut and Jobs Act was passed. This at the time was considered a monumental tax bill and is considered one of the biggest tax bills in modern history. Now, we're not going to go into every single little change that was brought about by the Tax Cut and Jobs Act, but here are some of the few ones that you might feel on a daily basis. So number one, it cut tax brackets across the board anywhere from 1% to 4%, giving us the current tax brackets that are in place. The second thing that it did is that it doubled the standard deduction, meaning that only about 10% of folks now itemize on their tax return versus taking the standard deduction. The third thing that it did is that it put a $10K cap on SALT deductions. So if you live in a state like California and paid $40K in state and local taxes, prior to the Tax Cut and Jobs Act, you could use that $40K in state taxes that you paid as a federal tax deduction against your income. However, with the passage of the Tax Cut and Jobs Act, you were capped at $10,000, and that's whether you are filing an individual return or filing a joint return. The fourth thing that it did was that it brought about a bunch of business-related tax cuts that might indirectly impact you. So for example, the corporate tax rate was cut to a flat 21%, and in addition to this, there was a new 20% tax deduction on qualified business income that was introduced for small business owners that operate businesses like a sole prop LLC or an S Corp. In addition to this, concepts like bonus depreciation, which allowed businesses and even real estate investors to take 100% bonus depreciation on assets in year one, was introduced to the mix as well. Now, when the Tax Cut and Jobs Act was passed in 2017, while Republicans had full control of Congress, they lacked the 60 Senate votes needed to circumvent a filibuster to make this piece of legislation permanent. So what was done instead was the Tax Cut and Jobs Act was passed as part of something called reconciliation. This only requires a simple majority vote, not 60 Senate votes. Now, why this matters is that in order for the Tax Cut and Jobs Act to pass, it needed to be deemed budget neutral, meaning it wouldn't increase the federal deficit after a 10-year window. So because of this, the Tax Cut and Jobs Act was put in place with an expiration at the end of 2025. So if we fast forward to today, where we have a Republican trifecta where they hold majority voting control, they don't have a supermajority, just like they did back then. Now, because of this is what I think is likely going to happen. So first and foremost, the Tax Cut and Jobs Act is likely going to be extended. It's likely not going to be made permanent since a supermajority would be needed for that. But I would say it's pretty safe to assume the current tax system that we have in place today with the reduced tax brackets, higher standard deduction, etc., are likely going to continue to stay in place to perhaps well past 2030, if I had to take a guess. Second thing to keep in mind is some of the elements of the Tax Cut and Jobs Act that were initially going to be phased out, like bonus depreciation, are almost no doubt going to be reverted back to 100%. So if you're someone looking to, let's say, buy a short-term rental and take advantage of 100% bonus depreciation in year one, I would bet that that's going to be back at 100% starting in 2025, and you could even retroactively make those years that were initially phased out back to 100%. The third thing to be aware of is that there's certain elements of the Tax Cut and Jobs Act that got pushed back even from Republicans. One of those elements of the tax law that Republicans in high tax states did not like was that 10K SALT cap. Again, one could only speculate, but I would guess that the SALT cap is going to be modified in some way. It might not be completely removed, but it could be indexed to inflation, or it could be doubled if you are filing a joint return. The fourth thing to keep an eye on is what is going to happen with corporate tax rates. Republicans have been very vocal on cutting the C Corp tax rate, or the corporate tax rate, from a flat 21% down to 15%. Now, when they cut the C Corp tax rate down to the flat 21% back in 2017, that introduced QBI, the QBI deduction, which is a 20% deduction targeted at small business owners. And the reason why this happened was to kind of level the playing field so that small business owners also got a nice tax benefit as well. So my guess is that if the C Corp tax rate gets cut down to, let's say, 15%, I would imagine the QBI deduction is going to be increased potentially as high as 30 to 35%. Now, if that happens, that's going to completely change how you would tax plan as a business, since you would want to do things to ensure that you absorb as much of that QBI deduction as possible. And even for someone who maybe runs a much larger business or is in a higher tax bracket, now making a C Corp election could make even more sense. Now, if you've been listening to this point, you've probably noticed I've talked a lot about either keeping current elements of the tax code the same or simply modifying existing elements of the tax code. So you're probably thinking about, well, what about all the stuff that Trump and Republicans campaigned for on the campaign trail, right? All the, talk about removing taxes on Social Security or tips or overtime, right? What about all that? Well, again, there could certainly be changes to that. It's definitely a possibility. I would say that those wish list items are less likely to happen than simply extending elements of the Tax Cut and Jobs Act that were already in place and set to expire. Part of the reason why I believe this is that there's a budget balancing act that needs to be factored in here. We have a massive federal deficit, and tax cuts can certainly spur economic growth, but they also can dramatically cut revenue to the federal government and potentially impact benefits like Social Security. Finally, what about all the tax credits associated with EVs and clean energy that were passed under the Inflation Reduction Act? Again, given the fact that when you introduce more tax cuts or extend tax cuts, you have to find ways to save money in other areas, there's a lot of speculation that certain elements of the Inflation Reduction Act will be repealed. So if you're someone interested in taking advantage of the EV tax credit, there's a good chance that 2024 might be the last year to take advantage of it. So there you have it, guys. We're ultimately still really, really early here. But as we start to learn more about new tax legislation that is going to be passed and what's in the pipeline, we'll keep you guys updated. So be sure to like and subscribe. Hope you guys found this helpful, and we'll see you next time.